Yeah, okay, for us.
Hi everyone, thank you very much for joining our investment webinar. We're pleased to be joined by Phil Bennett, Director of Silverstone Mortgages. So thanks for joining us, Phil.
You're very welcome. Thanks for inviting me.
Lovely name to your history, I'm sure. Silverstone and that car behind you.
Yes, that was a long time ago when the body was more willing than the mind.
And the mind and the legs still worked. Brilliant. So today we're going to try and talk about investing in property. Well, we are going to talk about investing in property. I'm joined by my colleague Michael here, one of our sales and lettings consultants. And as I said, we're joined by Phil Bennett from Silverstone Mortgages. So if we click over to the next slide. We're going to talk a little bit about the market in general. So to give you guys a bit of a background of what's been happening over the last couple of years. Obviously, 2020 was quite a turbulent year, to say the least. A lot happening in the world, let alone the marketplace. But actually, the property market has continued to grow throughout this period. So if we have a look at some of the stats behind that. So Mike, being on the ground day in, day out, what have you seen in the rental market?
It's been strong, especially since the end of lockdown, everything opening back up. Actually, the last 2 months, we've hit record months for how Centrick have done on the number of lets we've agreed. So that's really, really positive. Prices are pushing up, which is good to see as well. So yeah, been strong. As you can see there, across the UK in total, we've had quite a bit of growth. The average rent is now up to £889 per calendar month. And obviously Birmingham, being such a strong part of the market, is certainly seeing that as well.
Yeah, and I think it shows there. I mean, there's two or three key figures to take away. Is that the rental prices have increased across the UK by 5%, and we've not seen that before really in a 12-month period. And some areas have gone up by almost 7%. Mm-hmm. So really some quite steep growth curves there. So what's the driving force behind that growth, do you think?
Well, a number of things. Obviously, there was pent-up demand from what we sort of saw out of COVID, with a bit of a slowdown, a little bit of a struggle, people not really sure whether to move or not, and what really the next few months were going to sort of show. Everything was changing month by month.
Yeah.
So definitely that pent-up demand has sort of exploded in 2021. I guess we've seen a little bit more disposable income. People traveling less, a lot of people not really going on holiday as well. That's been sort of a back burner for a lot of people, but also everyday things, traveling to and from work. People haven't been able to go out the same, going out on the weekends. So I think people just found a lot more disposable income at the end of the month.
I think people have managed to save a lot more as well, haven't they?
Yeah,
a lot of the banks are recording record saving years, so positive in some ways.
And obviously people having that time and thinking, well, at home a lot more. I'll spend it on where I'm spending most of my time.
And I think as well, it's not costing tenants anything to move at the moment. So since the tenant fee ban a couple of years ago, obviously tenants are more free to come and go as they please without having to, in some cases they were stumping up anything between £600 to £800 for a move. So there's no real tie. And if you've been in that property for a while now through COVID, and you've mentioned a bit of pent-up demand, if you're not really enjoying that property and you're finding yourself spending a lot more time there because you're working from home, then I suppose you want that property to be right, and it's a bit more of an investment for you if you're going to be spending more time in it. It's like if you're buying a car, if you spend a lot of time in your car, driving around, you're going to want a nice car. So similar trend with property, I'm sure. Cool, next slide. So this is a graph showing what the average rental prices have done over the last sort of 10 years really. But I think the interesting part is that last spike that you saw, the one that's highlighted in red. So since 2019-20, we've grown by almost £90 a month on average. So that's almost a 10% increase in 12 months, just over, which is huge. And I think if you go back through the years, we've seen the same growth in 12 months that we did in probably 3 years or more. So all the factors that we've just talked about, I think, are really true when you look at a graph like that and really come to life. If we move more into then average sale house prices, so this is from Zoopla and the Land Registry, again, we're seeing a similar trend in house prices. So this goes back all the way to 2007, but what you'll see in the last few columns is almost sort of quarterly. So since January 2020, the average house price was just over 231. It's now up at just over 256,000. So again, record-breaking growth trajectory, I think, over that period. So yeah, again, number of reasons behind that: stamp duty holiday, interest rates being extremely low, so people taking advantage of that, which I'm sure Phil will come on to shortly. And again, pent-up demand, I think, through COVID.
And lifestyle changes as well.
Absolutely, yeah.
Sort of ties in.
So a big question on a lot of people's lips, I suppose, is do they remain to live in the city centres, or do they move out to a more rural spot? I think what we've seen, particularly in our Birmingham office, is the city centre is still an incredibly appealing place to live. Yes, it's probably not a forever home, but as Mike mentioned a little bit earlier, we've seen a record-breaking year in terms of number of lets being agreed. So absolutely, I think there was a conception before, whilst COVID was happening, that the city centre is dead. Actually, we're seeing the complete opposite, that people want to live in the city now, maybe want to enjoy life in the city for a period of time. Some of the key factors there that people are looking for, though, are outside space, larger properties to work from home, and obviously some breakout space for home working. So what you'll see, particularly in the new build world, is a lot of the developers are starting to integrate this into their development plans. So they're creating bigger units, the minimum space standards have increased. They're putting in plans for study areas, and they're also having a lot of breakout space in these developments, like communal space, whether it be larger gardens, planting areas, through to internal workspace in the common areas. So,
some cool rooftop terraces. Around.
Yeah, definitely.
Communal gardens. We've got communal workspaces as well, where you've got sort of coffee machines and something that people are really enjoying.
Definitely. So definitely a trend that way, and I think the developers of today are taking that on board and acknowledging it. So a lot of you might be asking, is now the right time to invest given prices are at an all-time high? Well, from what we can see in all the research we're doing, and Savills, one of the biggest real estate companies in the world, have forecast a 17% house growth by 2025, which is just huge, So as we've mentioned, rentals remain very strong and are growing. The attrition rates for those rentals are massive, and capital growth is suggested to increase. So we do believe, I think it's a great time to invest. I think there was a lot of historical concern around Brexit, obviously COVID, leading to lifestyle changes, but I don't know what you think, Mike, but I think this has really calmed down, like the Brexit fear. The banks haven't collapsed overnight.
Absolutely.
We're not all out of jobs off the back of COVID. So
I think there was also a lot of fear from outside of the UK of people moving to the UK, wondering, am I going to have to get a second visa? Am I going to be kicked out? There was that initial fear that has obviously gone completely, whether that's because they've been distracted by COVID, but obviously sort of come out in the wash a little bit, where people are much more confident now to move here from abroad as well. Yeah. So we think bricks and mortar is still a very good investment option, pension option, and something that you'll probably return more over the next 5-10 years than you would sticking your money into an ISA or a savings account. So also a question we're asked a lot, and I think many investors do query, is whether to buy new build or what we would call existing or second hand. Just before we move on, we've got a little poll for everyone in terms of this. Would you generally look to purchase new build historically, or would you generally tend to go for existing second-hand property? We're just trying to get that poll up if we can. So awkward silence while that happens, but hopefully we can let that run while we talk about some of the factors. So, Mike, what would your thoughts be on buying new build versus second hand? Slightly different vehicle in how it goes, and a lot of people do ask us because, especially on the investment side, people have often bought their own home, but not an investment property.
Yeah.
So a few points we've got there, which are sort of the key ones. A 28-day exchange, as many people will know, especially if you've bought in the last 10 years. The process takes a long time these days. Sort of, I think the average in the UK at the moment is about 14 to 16 weeks from offer accepted to completing. So quite a long time, nearly 4 months. With new builds, it can be done in 28 days. A lot of the paperwork is already prepared by the developers, so a lot of it's good to go with the solicitors.
Yeah, definitely.
You've also got the purchase security, so developers have no reason really for pulling out of sales. They're there to sell the property, whereas if you've tried to buy before, you may have found issues where whoever you're buying from, they need to find a place, and it might take them 2-3 months to find somewhere.
What's known as a chain.
Yeah, so sometimes you've got people who sort of sit back and say, oh, does it matter that it's chain free? Well, if you've had your fingers burnt before, as many of us have, and it's cost you nearly £1,000 for a sale falling through, you realise that no chain is a pretty good thing to have.
Yeah.
Not just that, but the time it takes where your money from doing anything, sitting in a bank, can take a long time. So next, you've got the peace of mind as well. A lot of the sort of things you've got around the new property, where you've got warranty for all your white goods, washing machine, fridges, things like that, boiler. You know, some people have bought a property, 3 days later their boiler breaks down.
Yeah.
3,000.
I've actually had that. I moved into a property, my first ever property I moved into, and the day I moved in, the boiler was broken. And I think it was like the 1st of December, so you can imagine it was freezing.
Beautiful. And you literally just got to stump up the money, right?
Yeah, absolutely.
So nothing you can do there. So all of that's covered. You've got building warranty as well, usually around 10 years.
Yeah.
So anything major, you're covered there as well. So a lot of peace of mind with that. Ready to let as well. Quite often, when you're buying a new build property, you can set things up, have it on the rental market between exchange and completion.
Yeah.
And you can find a tenant literally the day you complete, if not within a few days after, a tenant can be moving in. So
yeah, I mean, it's a newer model actually, but a lot of the developers we're working with are quite prepared to let the units out in readiness for you to complete. So some people don't know this option exists, but obviously the developers are quite motivated to do some deals at the moment. So yeah, they will pre-let the unit. So on day one that you complete, you're already returning capital and rental income. So, you know, you haven't got to then go and furnish it and get it on the market, and you know, ultimately have another one pretty much void. Yeah. So it's yielding income straight away. So that's a really good option. And if you've not spoken to anybody about that, then do ask one of our guys. I'd be more than happy to help.
Absolutely. Next one on the list, tenant preference. So a lot of tenants love the shiny, new, brand new sort of walk into the property. No one's lived in it before. We do find that people really keen for that at the moment, especially in city centre. Yeah. You know, you walk in, it's also
yeah, and particularly in a furnished unit, you know, the furniture's brand new, the bed's new, the linen's new, etc. So
can go a long way, absolutely. And then legislation and regulation. So a lot of you may have looked at properties where you've got planning issues or doubling ground rent issues. Nothing like that can come up with a new build. They're built as things should be right now, so no issues like that. It's going to sort of poke its head up halfway through the process when you've already paid £400 for searches, the survey, and a month later you realise actually you can't even proceed. Yeah, so there's a lot of benefits to buying new builds. Absolutely, yeah. Okay, brilliant. So from the poll then, so we had 40% people say they would historically buy new builds, 30% say they would tend to lean towards second hand, and another 30% said didn't mind. So interesting feedback there. Pretty equal. Okay. So I think what we wanted to try and get out of this webinar in particular was, if you don't have the cash sat there in the bank right now, how could you take advantage and buy another property, whether it might be your first, second buy-to-let, or your 10th? And actually what people don't realise is equity within your home, your residential home, or your built-to-rent buy-to-let property could actually be accessed. So Phil, perfect timing. Welcome, thank you for sitting quietly. So if we skip on to the next slides then. So Phil's going to talk us through, I suppose, mortgages in general, what the market's been doing over the last few years, and a nice working example to show you how you could, what we call re-gear, to improve and ultimately increase your rental income in your property portfolio. So thank you, Phil.
That's a very kind introduction, and thankfully the mathematics at the end are pretty vanilla. So I just wanted to, so let me just do a quick introduction. My name is Phil Bennett. I'm the director of Silverstone Mortgages, based in Silverstone, although because of the way that the world has gone to digital, and our call center has got national reach, so we deal with people all around the country. And because we're a mortgage broker, we tend to be mainly used in portfolio landlords or even individual landlords. It's basically any mortgage applications where a broker can add value. And this sector is perfect for our brokerage expertise. Happily, we're free, so you can talk to us at your leisure, and it won't cost you anything. We just get paid by the lender at the end of the process. So if we just take the next slide, before we drill down and talk specifics around leveraging existing properties, I wanted to just highlight to those that are already maybe landlords or portfolio landlords that you may remember, if you've been in the game long enough, that it's around 5 years since there was the change in regulation with regards to the way that rents were stress tested. That came into effect in 2017. And what it did, it kind of pushed landlords towards fixed rates of 5 or more years, mainly because that element of the market wasn't required to have the more onerous stress testing. And just for clarity, they define portfolio landlords as having more 4 or more mortgaged buy-to-let properties. And if we go on to the next slide, there were other catalysts around that time that were the introduction of the new additional stamp duty, which came into effect in April 2016, that affected people with second homes. And obviously, for the purposes of this, that included buy-to-let properties. And what that did is, again, forced people into sort of thinking about their portfolio. And I'm just highlighting it mainly because obviously 5 years on from that time, you may actually be in a position where a remortgage is quite useful. And if we take a look at the next slide, this is the bank base rate, and it goes all the way back to 2011. Obviously, the bank base rate was cut to 50 bips after the financial crisis in 2008, 2009. And then the economy had a little wobble around 2016, and it dropped to 25 basis points. And of course, that, because this had been historically low, at the time, historically low rates, there was an additional scramble to take advantage of these low rates that were in the market at the time. And if we look at the next slide, it's just to show the trend back in 2014, 2015, where you can see early 2014, there was a clear trend of 2-year fixes were very popular. Whereas towards the end of 2015, a 5-year fix was becoming a lot more popular for those reasons I've mentioned. And again, if we look at the average buy-to-let mortgage rates back then, the 2-year fix was going to cost you in the region of around 3.2% and a 5-year fix around 4%. Well, because of the coronavirus, we've got rates that effectively are around half those rates. So a 2-year fix typically now is around 1.5 to 1.7%. A 5-year fix just over 2%. Obviously, those numbers are slightly skewed depending on the fees. And one of the things, if you're interested to take out additional finance, is you've got to balance the headline rate with the fees that get applied, because typically the very low headline rates come with at times quite extraordinary fees, such as 2-year fixes at sort of 1.1%, attracting £3,000 worth of fees. And then obviously that rate is then not so attractive. If we look at the next slide, I wanted just to highlight that because these rates are so low, there isn't really a great deal of incentive to own more and more of the property. And especially so because, as this slide shows, where we're just looking, just to give you the starting point for these numbers, we're looking at a typical £200,000 property. The top numbers are based on a mortgage that would be available as a buy-to-let for 50% loan to value. And the bottom set of numbers, a 75% loan to value. So for those that are sharp with maths, the bottom set of numbers indicate £150,000 worth of debt. The top numbers, £100,000 worth of debt. And you'll see that because of the competition in the market, effectively, you've got 1.99% being charged on a 50% loan to value, but it only increases by 11 basis points at 75% loan to value. Obviously, the monthlies increase by, in this example, around £95 a month. And that's mainly not driven by the rate, but it's just driven by the fact that you've got another 50 grand's worth of debt. But the point is even at 75% loans to value or £150,000 worth of debt, interest only mortgage is typically £260 a month with zero fees. You can see if you pay the fees up front or even roll that into the loan, which ultimately would be more expensive, but from a cash flow point of view, it comes down to £173 a month for 75% loan to value. And what that highlights is the fact that it would be very easy, especially because at the moment there has been considerable capital appreciation on property across the board. So the £200,000 property that was going into this sort of virus pandemic is probably now up towards £220,000. So £20,000 of that headroom has come just from the last 12 months. And basically, in the search for yield, if that's your motivation, you'll know that fixed income or deposits placed in building societies and banks are yielding almost nothing. Government bonds are yielding very low. Obviously, that's tracking the base rate and then 3-month LIBOR. So even 10-year treasuries or 10-year gilts at the moment are yielding less than 1%. So that yield, you can see that reflected in equity markets. The UK equity markets now have had a healthy bounce from the lows. The US market, which is more tech focused, which is obviously the technology sector, has had a much greater kicker from the coronavirus pandemic. US markets are at all-time highs. The FTSE 250, which is the mid-cap index, is higher now than it was going into the pandemic. You can see even in crazy asset classes like cryptocurrency, which personally I don't understand and I don't really think many people do, but that's going gangbusters. And so if you're not into that kind of crazy speculative end of the market, bricks and mortar now seem pretty pretty safe and simple compared with that. And if we go to the next slide.
Just on that before we move on, Phil. So you're saying you could borrow £150,000 worth of mortgage ultimately, on an interest-only 25-year term, and it'll cost just £260 a month.
Yeah, I mean, so obviously, look, and just to put some small caveats around this, and it's not particularly crazy, but everybody that's watching this or everybody that will watch the recording, they're obviously going to have their own unique set of circumstances.
Yeah.
So this is a little bit of a catch-all, but essentially, if you were a landlord currently, and over the last sort of years, you've been effectively paying off your existing mortgage, you could either remortgage and take more of the capital out of the property, but on the remortgage, so you'd effectively raise capital against the property, and on that basis, £150,000 worth of debt at 2.1%, which is typical for a buy-to-let interest-only mortgage on a 2-year term, 25-year term, 2-year fix, is around £260 a month if you take a product which has got no fees attached.
Yeah, I just couldn't believe how cheap that was on a monthly
Yeah. I
installment.
mean, residential. If you're not a buy-to-let investor already, and you've just got you've got your main residential property, residential rates on a capital raise are down at sort of 1.3, 1.5% at this level.
Wow.
It's just, I mean, look, we've seen already from the prior slide how when interest rates are at 50 bips, they could go lower to 25 bips. And right now, base rate is at 10 basis points. So that's 0.1%. Can they go lower? Of course they can. If you look at the market, and by that I mean if you look at inflation protected treasuries, which kind of try and look at what the market's expectation is of inflation, there is, in the relative medium term, there is starting to become an increase in expectation of the market for inflation, which is in the longer term likely to drive rates higher.
Yeah.
But I haven't got a crystal ball, and people will take their own view on where rates are going to go. But even at the moment, these numbers here are based on 2-year fixed rates. 5-year fixed rates are really only pricing maybe 20 to 30 basis points higher. So it's relatively, at the moment, on a historic basis,
very affordable,
it's very cheap debt.
Yeah. Okay. Brilliant.
So if you take the next slide, I'll just show the worked example that I made. So basically, if you've got the £167,000 of buy-to-let property, and it's a new build, which typically requires a 70% loan to value. So you've taken your £50,000 worth of extra debt, put that into the new build property, and it's going to cost about £165 a month on a 2-year fix, plus the additional £95 that you paid for the remortgage of the other property. I think your other slides are going to show that property is broadly going to be paying you £900 a calendar month in rental income. So the net profit of that, obviously excluding other costs, is going to still see that you take £640 a month. I mean, it's an incredible piece of, it's very simple mathematics, and obviously you need to factor in your own circumstances, especially around tax and your own risk appetite and where you see the long-term trend. But as a bold, bare number, that's quite compelling, in my opinion.
Yeah, I mean, even if the rental amount was more like £700 on a property of that value, then you're just taking £200 off that bottom number, so it's still £440. Gross income and profit off that investment. So I don't think you'd be getting £440 return on your equity sat in your current property. No.
There's no way. And also just to highlight, there's been a lot of people that become fearful, I think, of buy-to-lets because of the financial crash, which is within all of our living memories. And what I think we've got to remember is that the mortgages that were being made at that time, so 2006, 2007, you know, they were 100% mortgages and more, sometimes 120% loan to value.
Yeah.
And it made people's portfolios very vulnerable to the shock of an interest rate rise.
Yeah.
My own personal opinion is that, first of all, we're looking here at a 70% loan to value mortgage, which is still very conservative. And I have to say, because of the way that the UK psyche is, I can't see a scenario short of almost nuclear war, actually, which would see property prices tank 30%.
Yeah.
And you've got to remember that the general economy, even though there may be some inflation expectation, which should typically drive rates higher, the general view is that's going to be transient, transient inflation, because there's been huge sectors of the economy that have been very badly hit. You know, you've got airline pilots being made redundant. You've got anybody in the, as they'll surely tell you, in the hospitality sector or holiday and leisure sectors that have been absolutely broadly wiped out by this crisis. And, you know, central banks around the world are just not in a position to aggressively hike rates anytime soon, in my opinion, Andy. So I think there is some comfort to be taken there. And the other element to this, which I think also needs to be taken into account, is the market generally, and bearing in mind the average property at 167,000 to 250,000 pounds is also got huge support from the fact that we've got the re-emergence of residential 95% loan to value, which has brought a lot of individuals bidding these prices up because they've got access to mortgages that they should have had access to before. You've got the stamp duty holiday, which still available until the end of June, although in truth you're unlikely to get involved in anything between now and the end of June. But it does still taper. There's still tapered benefit until the end of September. And you've also got the Help to Buy scheme, which has been extended. If you remember, the old original Help to Buy scheme for residential buyers ended at the end of 2020, but then they've got another new scheme which goes for another 2 years. So there's a lot of just fundamental support for property prices, especially down at this level, that'll take, in my opinion, again, another 2 or 3 years to wash through.
Yeah, totally agree. But yeah, I think some really clear, hopefully there for the people watching, some real clear working example of how you can make your equity work for you and make it return a monthly income.
Sure. Yeah. I mean, look, it's not very sophisticated maths. It basically plays on the fact that in a low interest rate environment like we have now, you may as well get as leveraged as you can to take advantage of additional income from assets. And actually, if you take any asset class really from the end of the financial crisis, basically asset owners have done exceptionally well since that time. The other thing that we spoke about earlier, which is another thing that could help people get involved if they haven't got headroom in their current properties, is also to speak to your financial advisor about whether you've got some liquidity that could come from pension. Obviously, you know, you're able to take a lump sum from your pension tax-free. And that's another, we've together, Andy and I have done buy-to-let investments from people taking advantage of that source of income.
Yeah, brilliant.
Thanks very much.
Thanks, Phil. I think that's really useful. And again, really simple maths, but it does what it says on the tin, I think.
Yeah,
cool.
Cheers. Obviously, if you need to get in contact with me directly or via Centrick.
Yeah, absolutely. If anybody's got any queries for Phil, do get in touch with us. We'll happily put you guys in touch with one another. That's what we're here for. So absolutely. So if we move on then to the next couple of slides, we want to talk a little bit about, obviously we're based in Birmingham, or our head office is. It's becoming quite an investment hotspot. We're seeing obviously that impact also trickle out into the wider West and East Midlands. So if we go on to the next slide. So Mike, you can take this one.
So the growth basically shown from January 2015, again, like the previous slide, when we get to the end bit from January 2020 onwards, we've split that into a little bit closer dates. What you can see there is a huge increase from July 2020. It was sort of plateauing and staying, sort of general line there from 2019, and then a huge explosion from 2020.
Yeah.
Quite a large growth, and we'll have some percentages next as well on the next slide. So here you'll see from the previous 6 years, from 2015 when that graph started, a 43.5% increase, which is huge. If you look at any other type of investments and you say to someone 6 years annual growth 7.2%, it's massive.
It's massive.
Yeah,
and I think that's where some of our clients in particular bought early. We've sold properties in Birmingham for the last 10, 12 years, and actually some of their portfolio has doubled in value, if not more. So actually releasing some equity is a really easy thing because they've got such low loan to values at the moment. The drawing out 30, 40, 50,000 pounds to reinvest is just an absolute no-brainer. I've just seen from the previous slides.
And those figures there are the whole of Birmingham. You can, pick the right spots.
Just city centre.
Exactly, yeah. Pick the right spots, you might get even more.
Yeah, brilliant.
Next slide. So a few more stats and figures for you. Homes required over the next 10 years. So this is sort of looking at what the government have put in and how many homes we need to keep up with demand. So property, like everything else, is supply and demand. With demand increasing, supply needs to catch up. So as you can see there, only 22.5% of demand is being met at the moment, which will continue to push.
And inevitably drive prices through the supply and demand theory.
Yeah.
Next slide. So we're going to talk about a few opportunities. Obviously, we've kind of looked at what the market's doing. We've looked at how practical it is to re-gear and drag some equity out and reinvest, and how affordable it is. So we thought we'd just tail this with a few opportunities that we've got in the market at the moment, and then at the end we can wrap up with some Q&As, both for us or Phil, and then obviously we can wrap up. But yeah, if we look at some of the local opportunities we've got. So Sheldon Court, we've actually just got one studio left there.
Yeah.
Mike, tell us a little bit about that.
So Sheldon itself, quite ideally situated. It's not too far from Solihull, which a lot of people may recognise. Really sought after area, great schools and transport links. Right side of Birmingham to access London as well. So a lot of Londoners moving up to Birmingham, as they have done for the last 10 years. Yeah. So that trend continues to move forward. So yeah, we've got one plot remaining there. There's a studio. As you can see, asking price is 148, but as it is the last plot, the developers there are keen to
quite motivated.
Yeah, get offers on the table really.
Yeah.
Expected rental of 700 a month, because it is a big studio. Benefits there, I mean, like I said, transport links, but HS2, there will be sort of like a crossover link.
Yeah, so it's just a couple of miles from the interchange station, which has been approved, obviously at the sort of what people would know as Birmingham International train station at the moment. So again, tagging on to the HS2 journey and story, nobody's really looked at Sheldon as a place to invest because of HS2. It's all been city centre.
Yeah.
But actually that station is closer to London than what Curzon Street will be. Yeah. So actually I think it's a bit of a hidden gem. It's really good PR around there. You've obviously got Resorts World, the NEC, Jaguar Land Rover, all around there. So I think we've already rented some of these units out for our investor clients, and they've been going very, very well. So definitely one we'd recommend.
Next is Broad Oaks. This one is based in Solihull, which we just mentioned, which has been extremely popular. we have different properties there. The studios, 1 bedrooms and 2 beds. You can see the sort of rough estimate pricing we put on that on a rental.
Yeah.
So those are per month. Quite a few incentives available, especially for sort of international investors. The furniture packs included, so property is ready to go from the offset. They're also offering this, as we discussed, 6% guaranteed yield. So for the first year, any rent that sort of falls short of 6%, you'll be topped up to reach the 6% for the first 12 months. Solihull, I mean, that one there, you're 2 minutes from the train station,
Yeah.
so into Birmingham City in no time, and also just around the corner from town centre, about a 5-minute walk.
Yeah, again, really good investment opportunity. Yeah, next one.
So Moseley, again, it's one of these sort of suburbs. I mean, I say suburbs, it's 10 minutes from Birmingham City Centre, where what we found a lot of, especially the Londoners moving to Birmingham, they love these sort of spots, especially after being here a year or two, getting their bearings. They're sure they want to live
A bit more leafy.
Yeah, absolutely. And it's such a small commute for them. Loads of posh fancy pubs, restaurants, parks, busy high street, which the Londoners are very used to. So different options there. We've got Moseley Central, 1 plot left there as well, which has just been reduced actually. It's on for 215. Expected rent there, 925, 900. It's 2 bed, 2 bath. Got another one, which is 1 plot available at St Mary's. That one comes with parking. That is on the market at 239,950. And then you've got Oakview at the bottom there, where we've got some 2 beds, also some 1 bedrooms available as well. A little bit further up the road. One major thing with Moseley is new train station.
Yeah.
So
the old one reopening.
The old one reopening, yeah. So a new line. It hasn't been talked about for a number of years. So if you're from Birmingham, you think, yeah, that's been spoken about, but plans are now done. It will be in by Commonwealth
Got
Games.
approval and funding. So yeah, we're expecting that to really improve the property prices, or help continue to improve the property prices in Moseley. Good. Next one. Is there any more?
There is, so some off-plan opportunities as well. So this one is estimated for completion in Q1 2022.
Yeah.
So you can get these sort of off-plan before the market moves up, as we expect to go for the rest of the year and into 2022. So they start at 270. Expected rents, I mean, 1100 is, if we were putting it on right now, we'd expect by that point, I mean, at least 1200.
Well, we've seen the growth that way over the last 12 months,
especially the last 2 or 3. So that is literally 3-minute walk from New Street Station, can get you all across the UK, nice and easily.
I think if you're looking at prime, like it says there, prime city centre, you don't get much more central than that. So opportunities to get in, reserve, only exchange on 10-15% equity, and then you sit and wait for completion, at which point hopefully again your capital value is increased, and so is your expected rental income. So good opportunity there. And I think we've got one more off-plan opportunity.
Yeah, so again, it's sort of in that midway from city centre to the suburbs, next to Bearwood High Street, down the road from Harborne. So you've got some big hospitals near there. You've got Queen Elizabeth, as well as the new Metropolitan University Hospital. It's only about a mile away. So really nice and easy. We've got 1 bedrooms there, start at 163, which is I mean, hard to find really for that type of size.
Definitely,
really good rental returns because of your sort of, you know, easy commute into city centre. Loads going on with commercial sort of buildings being built not too far away as well. New Garden Square.
I think you've got the nice balance there of Harborne on your doorstep, Bearwood. You've got Woolly Woods and Lightwoods Park. Like I say, you're just round the corner from the Queen Elizabeth Hospital. So you've got a huge sort of medical catchment for your tenants, as well as city centre commuters. It's probably 2.5 miles from the city centre. But still, you get that out of city feel. So yeah, really good opportunity there. So that wraps up all of our property opportunities. If anybody's got any questions, please do submit them. I think we've got one come in that's just, Phil, if you're still there, it'd be great to ask this. So somebody's asked, would it be more beneficial to extract their deposit from the remortgage, from their residential, or from their existing buy-to-let? I think we covered this, but I think they're going to, obviously, you'll be best placed to answer.
Typically, it will be cheaper to do the residential on a rate. Although obviously, depends on their cash flow. You may find that from a cash flow perspective, and also from a risk, because obviously, if you start to leverage against your main residence, then, you know, potentially if things go at all badly, then it's your main residence that is affected. But from a rate perspective, definitely leveraging against the main residence will be the cheaper.
Yeah.
But it may well be that it just becomes more palatable to leverage if you've got a buy-to-let portfolio, just to keep the business and things around business in one pot, basically. Yeah.
Yeah. So some variables. Ultimately, the rate is cheaper on the residential, but yeah, there are multiple options and caveats.
The other element, Andy, just sorry to cut across. The other element about the buy-to-let capital raise is that it's a lot easier to get interest only against a buy-to-let than it is the main residence, because for all interest only options, you need to have a credible explanation as to how you see yourself funding the capital amount at the end of the loan term.
Yeah.
And for a buy-to-let investment property, the sale of that property is seen as a credible solution, whereas it isn't for your main residential typically.
Okay, brilliant.
Cheers.
Well, Phil, thank you very much for your time. Really appreciate you joining us. As we said earlier, if anybody's got any questions or would like to explore this a little bit more, do get in touch. We'll happily help and put you in touch with Phil, and also obviously show some more opportunities across our group. But unless there's any other questions that have come in, no. Thank you all very much for joining. I hope you have a great evening, and we'll share this webinar around with you afterwards. Take care, everyone. Thank you.